Is a deflationary recession looming on the horizon? Discover expert insights.
Right. And with gold hitting record highs, investors are eager for answers.
Join us for timely summaries of what the experts say about the economy.
Welcome to Financial Insights in Minutes, your go-to for market intelligence.
Let's dive into the standout videos from today's financial landscape.
Coming up, crucial analyses from top voices in finance. First up, McGlone discusses the signals of a global deflationary recession. Next, Eurodollar University delves into gold's surge to record highs and its implications. Tune in as Figuring Out Money analyses the anticipated great shakeout of 2024. Following that, Krauth explains how Fed cuts could bolster silver investments. Then, Mott Capital's insights reveal potential market reversals in the near future. Lastly, Vermeulen warns of a dead cat bounce in stocks while forecasting a bond rally.
Welcome back to David Lin's channel. Today we're exploring whether we're witnessing a global deflationary recession, referred to by our guest as the reset of a lifetime. Joining us is the incredible McGlone, senior commodity strategist at Bloomberg Intelligence.
It's a pleasure to be back. This topic is crucial as we dissect market movements, particularly Bitcoin, even in turbulent times.
So, what's at the root of Mike's perspective on a global recession?
The core thesis wraps around the notion that significant shifts in the market indicate a deflationary trajectory. With volatility affecting Bitcoin and commodities, McGlone warns of underlying troubles.
Let's break down the major insights from Mike's analysis. Starter question: what's causing this recent market upheaval?
The volatility surrounding Bitcoin suggests it's a bellwether for the overall market. If it falters, other assets could follow. This is an important signal to watch.
What's the story with Bitcoin and gold, those shiny assets?
In the current volatile environment, gold continues to outperform Bitcoin. Historically, these correlations often foreshadow movements in risk assets.
And how does employment fit into this economic puzzle?
A significant rise in unemployment often precedes recessive trends. Such projections suggest that consumers may tighten spending further.
Commodities are moving in a concerning direction. Give us the scoop.
The drop in commodity prices, alongside gold's rise, hints at a major economic reset is underway, a sign of deflation indeed.
What does Mike predict for unemployment?
There's a firm outlook of jobs dropping to around 5%. It's going to affect consumer behavior.
What's happening in the commodity markets?
Predictions suggest a continued downturn, which could disrupt investor confidence and market stability.
As we wrap things up, what key takeaways should we gather?
The future of economic stability seems tied to rising unemployment and declining risk assets, while gold shines brightly as a safe harbor during these turbulent times.
We want to hear from you. How are you adjusting to this economic forecast?
Comment below with your thoughts on navigating these turbulent times. Your perspective is valuable.
Welcome to Eurodollar University. Today, we're diving deep into the remarkable surge of gold, hitting new record highs. But what does this mean for the financial landscape?
That's right. The safe haven demand for gold is skyrocketing. And with the stock market rallying, we're left with many unanswered questions about what's really happening beneath the surface.
What do we need to know about this surge in gold?
Gold prices have soared above $25.50 per ounce, reflecting increasing risks and uncertainty in the global economy. This surge is driven by safe haven demand amidst fears of a recession.
What drives this new pricing for gold we're witnessing?
Economic indicators are weakening. Gold closed at $25.64 today, while both oil and gas are witnessing significant price drops due to diminishing demand globally.
How are stocks holding up amidst this economic turmoil?
Surprisingly, the stock market is on a bull run. But this rally is misleading. It doesn't reflect the true economic climate filled with uncertainty.
And how do interest rates tie into all of this?
As interest rates drop, owning gold becomes less costly. This shift directly influences increased demand, pushing prices even higher.
So, is this just a localized issue?
No, it's a globally synchronized downturn. Economic indicators suggest that weakness across major regions is a significant concern.
So, what does the future hold?
Predictions suggest rising unemployment rates, which could amplify safe haven investments like gold. The storm isn't over yet.
Looking ahead, what's on the interest rate horizon?
Markets are bracing for significant cuts, and that could send gold prices soaring even higher. Keep your wallets ready.
To wrap it all up, what should we take away from this?
Gold's unprecedented rise indicates profound economic challenges ahead. Investors should remain cautious and consider their strategies carefully in these turbulent times.
Before you go, we'd love to hear your thoughts. What's next for gold and the economy?
Join the conversation in the comments below. Your insights could shift the tides in this economic narrative.
Welcome to Figuring Out Money. Today we're navigating through the stock market currents with a fresh briefing, the great shakeout of 2024. What signs point to upcoming turbulence?
It's going to be a wild ride today. Stock volatility, market trends, and potential shakeouts are all on the table. So whether you're a seasoned trader or just managing your portfolio, there's something here for everyone.
What's the core thesis here?
The thesis revolves around the idea that the markets are primed for a shakeout due to low trading volumes and several major economic events on the horizon. With the ongoing expansion and contraction phases of trading, the pressure is mounting.
Let's get to the juicy details. What's the market overview?
The latest analysis reveals a mixed situation in the S&P 500, with consumer staples and healthcare shining while energy took some hits. It's a roller coaster ride out there.
What about the volume trends?
Volume is dropping like a lead balloon. A decline in volume combined with volatility could set the stage for a shakeout event. We must keep a keen eye on those trends.
Upcoming events are always a wild card. What's on the docket?
Economic events like the FOMC minutes can stir the pot significantly, and key earnings from retailers will give us a glimpse into consumer sentiment, which is crucial.
And what are the big predictions coming out of this?
Expect heightened volatility after the report releases. Price corrections could very well be on the horizon, making it critical to stay informed.
And what about the consumers?
Retail earnings will give vital insight into consumer behavior. If spending trends shift, it could rattle market stability.
As we wrap things up, what should investors take away?
A cautious approach is advised. The markets are primed for potential shakeouts, so being vigilant as events unfold could be the key to success.
Before we finish, any final thoughts?
Stay tuned to macroeconomic indicators and volume trends. These will play pivotal roles in navigating the turbulent seas ahead.
What do you think is going to happen next?
We want to hear from you. Drop your predictions and thoughts in the comments section below.
Welcome to Kitco News. Today's excitement centers around silver, especially as the Federal Reserve might cut interest rates. But is the path to silver's rise as straightforward as it seems?
That's right. Peter Krauth, who brings invaluable insights as the editor of Silver Stock Investor, joins us today to discuss why silver may be on the verge of a breakout amidst the complex economic landscape.
Let's get to the core thesis. What's the crux of Peter's argument about silver's potential?
The main idea is that even with low inflation and anticipated cuts in interest rates, silver might benefit greatly. There's a unique situation developing with high Chinese demand and dwindling inventories, suggesting silver could skyrocket.
First up, let's talk about inflation. What did Peter have to say?
He highlighted that inflation may be lower than 3%, but is still a concern. The Producer Price Index shows a 3% rise when adjusted, hinting inflation could linger longer than expected.
Now transitioning to gold, what's the significance of its recent performance?
Gold has reached new highs, which often drives investment interest. Peter mentioned that historically, silver tracks gold, but can lag, potentially setting the stage for a major rise in its value.
What role does China play in the silver market?
China's massive production of solar panels drives silver demand. They've shown record imports, emphasizing the country's influence on the market.
So what predictions did Peter share about the future of silver?
He believes silver is likely to surge, especially following any rate cuts by the Fed. Historical trends indicate that silver tends to appreciate significantly during rate cut cycles.
Let's dive into predictions further. What's on the horizon for silver?
Peter forecasts a significant surge in silver prices after anticipated Fed rate cuts. With historical performance backing this claim, he suggests silver's rise will outpace gold.
To sum it all up, what does Peter conclude regarding silver and the Fed?
Ultimately, with the Fed's looming rate cuts, low inventories, and rising demand, silver looks set for a bullish run. It's a perfect storm for silver enthusiasts.
As we wrap up, we want to hear your thoughts. Do you believe silver will soar?
Drop your predictions in the comments. It's your chance to weigh in on this potential silver rally as we navigate these tricky economic waters together.
Welcome to Mott Capital's Market Chronicles. Let's digest some intriguing market trends. Today, we're diving into potential market reversals. Are we in for a shakeup?
Exactly. This property man tells us that currency pairs could signal a big shift in the equity markets. Don't blink, there's a lot to unravel.
Let's get straight to the facts. What's the core thesis today?
The main takeaway is that movements within currency pairs, like the Mexican peso and Canadian dollar, might foreshadow a significant reversal in the equity markets. This is crucial since these trends have a distinct relationship with the S&P 500.
What's creating the buzz around the Mexican peso?
Well, it's breaking out from a downtrend showing bullish momentum. Despite recent weakness, signs are pointing to a potential upward rally, especially with resistance levels shifting.
And how's the Canadian dollar affecting market signals?
After weak Canadian CPI data, we see USD CAD potentially were set for a bounce. This could indicate a reversal at an important support level that often correlates with the S&P trends.
Shifting gears, what's the scoop on the USD JPY?
After breaking vital support, fears of continued weakness loom. The yen's current strength could invert trends in equity markets, making it a vital chart to follow closely.
What predictions are on the horizon?
Experts anticipate a significant pullback soon. The recent rally seems excessively optimistic, and with several indicators flashing warning signs, caution is warranted.
And what about the equities?
If current currency trends persist, a retracement in equities seems probable. Keeping an eye on trends from the Canadian and Mexican sides will be essential for foresight.
As we wrap up, what are the key takeaways?
It's clear that currency movements provide valuable insight into potential market shifts ahead. Stay alert, as changes in these dynamics could spell big implications for equities.
We'd love to hear your thoughts. What predictions do you have for the markets?
Make sure to drop your comments below. Let's keep the conversation going.
Welcome to David Lin's channel, where we navigate the ever-changing waters of the stock market. Today's focal point: are we witnessing a dead cat bounce or a slow bleed in the market? Chris Vermeulen, founder of thetechnicaltraders.com, joins us to unravel these trends.
Exactly. Chris is known for his prowess in technical analysis and market forecasting. With his insights, we're about to dive deep into what this means for investors in the coming months.
What's the main thesis that Chris presents?
Chris suggests that we might see a temporary bounce in stock prices, but warns of a slow bleed thereafter, with bonds poised for significant appreciation. It's a classic case of what goes up must come down.
Let's jump into the key points Chris has outlined, starting with market volatility.
Chris emphasizes that the recent volatility is driven by a mix of global events and fluctuating economic indicators. Traders need to stay agile like a cat on a hot tin roof.
And how about the bond market? What does Chris predict?
According to Chris, bonds are likely to gain traction as stocks decline. Smart investors might want to position themselves in bonds now before the wave hits.
Investment strategies need to adapt. What's Chris's take on that?
Chris stresses that adapting strategies is essential in these uncertain times. Keeping an eye on key market indicators will help inform better investing decisions.
Moving to predictions, what does Chris foresee for stock prices?
Chris forecasts a decline in stock prices, warning that investors should brace themselves for challenging conditions ahead. Buckle up, it might get bumpy.
And for bonds?
Chris anticipates that while stocks struggle, bond prices could soar. This shift could change the landscape of investments considerably, and being prepared is key.
So, what wraps up our discussion here?
In short, investors must stay vigilant and adaptive to navigate these turbulent market waters. The right strategies now could yield fruitful results later.
Before we sign off, what trends should we keep an eye on?
We want to hear from you. What market trends are you watching? Drop your thoughts in the comments below. Let's keep the conversation going.
Today's discussions highlighted pressing predictions from various financial experts.
While some foresee a rocky path ahead, others note opportunities, especially in precious metals.
Ultimately, the key takeaway: stay vigilant and informed as we navigate this fragile market. If you'd like more time-saving content, please remember to... Thanks for watching Financial Insights in Minutes. for August 21st, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.